Hey, Kevin, I own this individual company. It's going to the moon. You got to own it too. I picked a number of stocks and they've all gone up. So, hi everybody, this is Kevin, a CPA that does financial planning, and a number of people have asked us, should I own individual companies? That a friend of theirs, he or she made a fortune in this company. So I do think it's a really fair question. It's something we should look at. So in this video, I'm going to show you some evidence about why picking individual stocks is such a difficult thing year in and year out.
So yeah, everyone hated statistics except for a few people, and they're fantastic at it. But I'm going to talk to you about a concept called skew, and I'm just going to talk about it when it comes to stock returns. So if you want to be a stock picker, this is the reason why it's so difficult to beat the market, okay? It's because of skew, okay? This is a histogram of one-year S&P 500 components. So these are, these are the returns for 1 year. And I'm going to show you another chart here that's a little bit easier to understand. It's not the actual data from a year, but it's the concept here. It's from PIMCO. Now, PIMCO, they're basically arguing in this piece that bonds have negative skew and therefore active management works. And they're saying it's very difficult for stock pickers to beat the market because of the positive skew of stocks. So what is this? Well, this is the median. Okay, you can see it here as well, and that the typical 50 percentile investor ends up failing to beat the market, even if there were no fees or commissions. Okay? Now why is this? Well, stocks can lose up to 100%, right? You have a stock that's $100, it goes to zero, you'll lose it all. Okay? That's one of the risks of owning an individual stock, is it can go to zero. Markets will only go to zero if the world goes bankrupt, and we'll all have bigger problems. But equities can go up more than 100%. They can go up 400% in a year. So these winners, all of these winners here, actually can pull the return up in a given year. There's only a small percentage of stocks in a given year that really are responsible for the majority of return. And I'll prove that in a second. But getting back to this conceptual piece here, is you can see the 50% line here. More stocks fall below it than fall above it, and again, the tail is not as fat. That's the lingo for it. But basically, a lot of stocks do a little bit worse, and this is not negative returns. This is versus the market. More stocks end up not doing as well as the market. Okay. Now, what happens with these stocks up here is if you don't own all of these stocks at the top, if you will, all the real performers, if you don't own them in a given year, your returns suffer and you don't meet the market. And that's the reason why indexing has taken over. That's the reason why passive management is the way to go. That's the reason why stock picking, it's known now that it's not such a good way to try to invest, although we all want to do it. And it's exciting to own a company and see somebody play the lottery ticket, own one company, and get extremely wealthy. It's exciting to see. So FANG or no FANG? So what is FANG? Well, FANG is Facebook, Amazon, Apple, Netflix, Google. 10 years ago, many of these stocks were actually heavily shorted companies. And that just means people are betting that they're going to zero. Now, 10 years later, we know that these were great companies to own. This was a fantastic time period to own these companies, okay? People talk about getting rich off the FANG stocks. Well, actually, the difference between owning FANG and not owning FANG in 2009 to 2018 was less than 1%. When you include it into a portfolio. Okay, so it's gonna look not as good as if you just own those 5 stocks. If you take those 5 stocks out, you're still going to do well owning the market. Okay, but this is the part that I think is even more interesting. Is all stocks in the global portfolio from 94 to 18 did 7.2. If you just take out the top 10%, you get a bad return. So you just take out the top 10% of the companies. The return goes down to 2.9. Now let's take out the top 25% of the companies. It goes negative. So the point here is reliability of returns. If you own just a few stocks, yes, you can hit a home run. And these home runs are there. But most of the time, you're not going to hit home runs, and you're going to end up bringing your returns lower. and this is the reason why owning individual stocks, unless it's a tremendous reason why you want to do so, there are some instances where owning individual stocks makes sense. It's better to have a diversified portfolio. So just missing out on the top 25 every year is a bad thing.